Weekly S&P 500 Index (SPX) analysis. Bullish momentum continues amid economic reports. Last week we wrote, trading has slowed as we enter the summer months. For this full week, the S&P 500 Index (SPX) lost -0.08%. Almost dead even. This week, robust gains in a shortened trading week. In only 3.5 trading days, the S&P 500 Index (SPX) rallied plus 1.95%. The trend remains strongly to the upside. The conservative S&P 500 strategy is designed to protect investors from bear markets. Short-term declines are endured and should not trigger sell signals. The aggressive bull and bear report follows short-term indicators in more detail. The conservative strategy is based on long-term chart analysis and does not make changes based on emotions, news events, etc. This is a long-term strategy. It is designed to allow fluctuations in the market and not try to market time every little up and down. The strategy is very long-term oriented. We are in a bullish position in the Rydex S&P 500 Nova Fund, RYNVX, or other S&P 500 Index Fund or ETF such as SPY. S&P 500 Index, SPX, and current chart analysis. Last week, the S&P 500 Index, SPX, continues to show signs of being overbought. This Friday, after initial gains, the SPX sold off and closed with a bearish reversal day pattern. Lower lows and higher highs than the previous day, but closing at those lows. This week's developments. The S&P 500 Index, SPX, is powering higher and gained a strong plus 1.9% this holiday shortened week. Indicators are sometimes wrong. But breadth is so important that we are still watching carefully for either a drastic improvement in breadth or a bearish reversal in the SPX. You must admit though, this weekly chart of the SPX is extremely bullish. The SPX is up plus 18.4% in only 6 months. This was the 32nd new all-time high this year for the SPX. The U.S. stock market extended its summer rally, with the SPX index climbing to yet another record high Friday as investors weighed the latest jobs report. This Friday ended the week with new all-time highs for both the SPX and the NASDAQ 100 index, NDX. Small caps continue to underperform, with the Russell 2000 ETF, IWM, losing -1.09% this week, while the SPX powered higher, plus 1.9%. There is a huge profit potential ahead when small caps rally. It has to happen, but when? A good bet is when the Fed actually does lower short-term rates. That may well be the time to buy into this sector. Market-moving economic reports released this week. Jobs report, mixed signals. The U.S. economy added 206,000 jobs in June, while the unemployment rate rose slightly to 4.1%, according to a report Friday from the Bureau of Labor Statistics. While jobs growth in the U.S. labor market is slowing this year, the unemployment rate remains relatively low. The economy is cooling, but not collapsing, said Andrew Slimon, senior portfolio manager for U.S. equities at Morgan Stanley Investment Management, in a phone interview Friday. The market is not pricing in anything more than a slowdown. Private business employment. Private businesses in the U.S. added 150,000 jobs in June, slowing slightly from the revised 157,000 gain in May and missing the consensus of a 160,000 increase, according to the ADP. Additionally, continuing unemployment claims rose to a 2.5-year high, adding to the view of a softening labor market. The number of people claiming unemployment benefits in the U.S. rose by 4,000 to 238,000 in the last week of June, above market expectations of 235,000, to remain relatively close to the 10-month high of 243,000 from earlier in the month. Additionally, continuing unemployment claims rose by 26,000 to 1,858,000 in the earlier week, the highest since November of 2021. Interest rates. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, $766,550 or less, increased by 10 basis points to 7.03% in the week ended June 28, 2024, from 6.93% in the previous period, data from the Mortgage Bankers Association showed. It was the biggest jump since mid-April, despite market expectations for an interest rate cut by the Federal Reserve later this year. U.S. economy and jobs report. The U.S. economy created 206,000 jobs in June, a decrease from a downwardly revised 218,000 in May, but above market expectations of 190,000. Job gains occurred in government, healthcare, social assistance, and construction. Meanwhile, the jobless rate ticked up to 4.1%, the highest since November 2021. Average hourly earnings for all employees on U.S. private non-farm payrolls increased by 10 cents, or 0.3%, to $35 in June 2024, following a 0.4% increase in the prior month and slightly below market forecasts of 0.4% gain. In June, average hourly earnings of private sector production and non-supervisory employees increased by 10 cents, or 0.3%, to $30.05. Conclusion: bullish outlook with caution. The SPX position in this strategy is bullish. Aggressive traders should be in the Rydex S&P 500 fund RYNVX or other bullish S&P 500 index fund or ETF such as SPY. However, keep an eye on market breadth and economic indicators for any signs of a potential reversal.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.